Welcome to our Market Pulse webinar, where we will be sharing our latest consumer credit trends from the third quarter of 2023. And as this is our last session of the year, we're also going to be giving you a bit of a sneak peek into what we think the outlook will be like for 2024. So my name is Rebecca Oakes. I'm the Vice President of Analytics here at Equifax, and I'm joined today by Kathy Katsouleris, our VP of Consulting, and Swarnima Pandey, who heads up our Insight team. So before we get started, I'm just going to hand over to Sandra, and she's going to talk you through just how the On24 platform works. Sandra.
Thanks very much, Becky, and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the media player, so please feel free to enter any questions you may have, and we'll try and address them throughout our session today. In the event there's too many questions to get through, we'll reach out to you individually to follow up in the coming weeks. Today's presentation in English and French, as well as some related content, are available for download in the related content area. We will be recording our session today, and you'll receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are reactions. Let us know how we're doing. Register now for two upcoming events, our Q3 2023 Business Trends webinar on January the 11th, and Credit Health webinar and demo on January 18th. Our survey, it's available anytime, and you can also see it as a pop-up at the end of the webinar, as well as contact us. Feel free to check any of these out and provide your feedback. We'd really appreciate it. Now let's get started. Becky, over to you.
Fantastic. Thank you so much, Sandra. So we're going to start off talking a little bit about the economy, because we always like to relate that back to what's happening on that side as we look through our credit trends. Now, one of the burning questions many have had this year is, will Canada enter a recession by year end? Now, there really are a few different opinions, but the GDP numbers reported recently did show a bigger than expected drop in the third quarter, demonstrating that there really is some slowdown in the economy, but technically we're not in a recession yet. The job market here in Canada has been very strong though, and in the second quarter, job vacancies were still fairly high, a little bit over 800,000. But there are some signs of cracks starting to show. We've heard news recently around some large organizations reducing staff numbers, and we saw the unemployment rate showing a slight uptick in October to 5.8%. Now, I say there are a few different opinions on whether we actually are in a recession or not, and that's really because what some of these numbers do mask to a degree is the impact of population growth, primarily coming from immigration. So Canada's population grew by around 1.2 million in the last 12 months. And when you start to take that into account, we actually see that although the employment levels have been rising, it potentially hasn't kept up with population growth. So when you look at that chart on the right-hand side, that red line is the employment level, and then that gray line showing the employment to population ratio. And it really brings to light just how that actually has been dropping given that population growth. Now, we are looking at this as a hard, soft landing, and that's really because there are some things which have been helping the Canadian economy for some time. Post the pandemic, we actually saw disposable income rising at an overall level, and although household expenditure that rose also primarily due to inflation, it was still a positive net result for many consumers. Now, what we are starting to see is that that benefit that we saw during those months really is eroding now, and those two elements are becoming closer to one another. So as you look at that chart on that left-hand side, that blue line is really showing that household disposable income and the change that we've seen actually going back to 2016, but in particular, we're focusing really on what's happened just before and after the pandemic. And then that household expenditure, the orange line, we see that kind of drop off throughout 2020. And it is starting to rise again. And the interesting points are really those last few data points where we're seeing that closure kind of happening between the blue and the orange. And that's where that gap is starting to reduce. So if we kind of break this down a little bit further and look at the ratio of household income to consumption by income quintiles, what we're starting to see is maybe a little bit more concerning. So for all income groups, we saw that big growth in income versus expenditure during 2020, which are the blue bars on that right-hand chart. And if you look at it, 4 out of 5 of those income quintiles of consumers had an income to expenditure ratio of 1 or more in the second quarter of 2020. So that means that their income was higher than expenditure. Now, what we've seen is that has been reducing year on year. And if you look at the last kind of bar in each of the quintiles, you'll see that in the second quarter of this year, it's only those 2 top income groups that actually are falling into that category where income is actually exceeding expenditure. So we definitely are seeing some slowing of the economy here in Canada, and the interest rates are starting to have a more, I guess, meaningful impact in the direction that the Bank of Canada was rightly hoping it would do. And this is really quite visible in our inflation rates, which fell from 3.8% to 3.1% in October. And if we look at what's happening globally, Canada's actually faring fairly well compared to some of the other regions, in that our inflation number is one of the lowest of the ones that we regularly look at. The US is pretty close to us, currently sitting at 3.2%, and Australia and UK are seeing some inflation slowing, but they're still over 4%. Now, the real challenge for Canada on the economy side, of course, is going to be to getting that number back to the target rate, and especially when we still have this continual population growth. That means new demands entering the market continually, and that obviously helps to keep prices that little bit higher. So that's kind of what's happening on the economy side. So let's talk a little bit around what are we seeing in terms of the impact on the credit side of things. And there's really 3 broad trends that we're going to be digging into today. And some of these are really continuations of what we saw in the second quarter, but we're also starting to see some new movements in a few areas as well, which we'll be talking to you about. So firstly, we have unsecured lending, and we are continually to see a little bit of movement on the balance side of that. And in particular, we're seeing payments starting to change for some of those products. So we'll talk to you a bit about what's happening there. Secondly, we've got the, I guess, continued impact on the mortgage market and secured lending from those really high interest rates. And then finally, we're going to step into, some of the financial stress that we're starting to see come through. And in particular, we're seeing this now for certain geographies. And that's really, again, linked to kind of the impact that interest rates are having for certain groups of consumers. So when we look at overall consumer debt as at the end of September, it was sitting at around $2.44 trillion. Now, mortgage continues, of course, to be the largest component part of that, making up around 75% of the overall debt levels. And if we look at how these are increasing, we saw the non-mortgage debt rising around 1.2% compared to Q2. Now, that's quite typical from a seasonal standpoint. We often do see non-mortgage debt rising a little bit in the third quarter. But as I kind of just mentioned a couple of minutes ago, when we look at that at a product level underneath, there are certain consumer groups where we're seeing a bit of movement, certain geographies where we're seeing a bit of movement. And so we're going to dig into that in a bit more depth later. And then mortgage debt, that rose around 1.7% compared to last quarter. And again, that's similar to what we saw in 2022 from a seasonality standpoint, but it's well down from the growth levels that we saw in 2021, when obviously the housing market was a little bit more buoyant before the interest rates started to go up. Now, as I mentioned earlier, population growth is still very impactful for Canada, and some of the balanced growth that we've been seeing over the recent years is directly linked to that increase. There's more people entering the country, and they, of course, will be using credit, and that leads to debt levels rising overall. But we do also look at average debt of consumers who are actually active in Canada. Now, at the end of Q3, when we look at the non-mortgage side of things for consumers, that average was sitting at a little over $21,000. Now, that's actually a drop of around 0.8% compared to last year. So it looks like average debt's going down, but when you actually start to break it down, the reason we're seeing that drop is really because of that population growth. So if we look at consumers who are much newer to using credit in Canada, those with a file who are opened kind of less than 3 years ago, we're seeing significant growth in that population. So when we take all active credit users, around 11.5% are less than 3 years old when it comes to having a credit file. And that's growing. So that's an increase of around 21% year on year. So why that's important is when you first start using credit, be it because you've just become of an age where you are using credit for the first time, or be it because you've entered the country through immigration, your balances are going to be much lower. You have less access to credit, it's less easy to get access, and it's going to take time for those balances to increase. And that's really the driving force behind what's happening with that average non-mortgage consumer debt. Those levels are down compared to last year because we're seeing the mix of newer credit active consumers in the population. If we actually look at just more established credit users here in Canada, so those where they've had a credit file for 3 years or more, what we're seeing is non-mortgage balance on average is rising. And in particular, it's rising for certain geographies like Ontario and British Columbia. And that's one of the trends I mentioned a little bit earlier that we are going to dig into around why that might be happening and some of the linkages to interest rates and the housing markets in those regions that potentially is causing that variation to happen. So if we start to look in a bit more detail at that non-mortgage debt growth compared to 12 months ago, it remains primarily in the credit card space. And in fact, when we look at some of the other products like home equity lines of credit, we're actually seeing a little bit of pulling back now in terms of usage of some of those products. Now, home equity lines of credit, we know, can be impacted by interest rate rises as well, but it's really in the credit card space where we're seeing that increase come from. So compared to last year, this overall non-mortgage debt has risen by close to $20 billion. And you'll see on that chart on the outer ring, 15.6 billion, or around 78% of that, is being driven by credit card balance. So if we just take a little bit of a high level look in terms of what's happening with payment behavior on credit products, this chart is showing you the 30 plus balance delinquency levels. So by 30 plus, what we mean is this is where a consumer has missed 1 or more months of payments for each of these products. And we're looking at, from a balance perspective, kind of what that change looks like. Now, what we are seeing is continuation from Q2 around increases in missed payments year on year. And if we go and look back to 2019, many of these products are either at or now close to the rates that we saw before the pandemic occurred. So auto loans and unsecured lines of credit are sitting actually at or above. I think unsecured lines of credit, if you look at the chart, is now above the 2019 Q3 levels. And installment loan and HELOCs, they're getting quite close to what we saw in that comparable time period. And it's really only credit cards and mortgages where we're still seeing a bit more of a more positive position, where those delinquency levels are still below what they were 4 years ago. But it is worth caveating that a little bit because both of those products have seen significant growth in balance over the last few years. We just talked about the credit card balance increases that we're seeing this year alone, and obviously for mortgages, with house prices the way they were, we saw mortgage balance rising quite significant during the pandemic. And so when you have that fast growth in the denominator or the bottom number that we use in something like a delinquency rate, it can take time for those missed payments to catch up and kind of mask some of the potential stress that's coming through. Now, both those products are seeing delinquency levels rising. They're just not quite up to those 2019 levels. Now, reaching 2019 levels isn't necessarily a surprising thing, as that was the last period where we had, I guess, some kind of relative normality when we're looking at the credit industry. But the key thing for Canada is the growth in those missed payments isn't slowing down yet. And as we go into the outlook of what we expect to see for next year, we do expect these to continue into 2024 in terms of growth and delinquencies because of the current economic conditions. So if we take a bit of a break from the product view and look at a general consumer view, what this actually translates into is that we saw around 138,000 more consumers missing at least one payment on a non-mortgage product compared to 12 months ago. And if you include mortgage as well, that's a little bit closer to 140,000 more consumers missing a payment. So that's around 1 in 25 of all consumers missing some sort of credit payment in the third quarter. Now, we're seeing that increase in missed payments continuing to come from across the population. Living costs obviously have been higher. We've just, we heard at the start, the economy side, employment starting to soften a little bit. But the fastest change that we're actually seeing, unfortunately, is currently sitting with consumers who have a mortgage. When we look at that group and look at whether they've missed a payment or not, compared to last year, it's around 10% up in terms of the levels that we're seeing. And compared to last quarter, it's up 5.5%. And Swanham is going to be sharing a bit more hard data in terms of why we're seeing that and where that's coming from a little bit later on. So a little bit of good news for Q3 is that we did see a bit of a drop off in new insolvencies coming through. The third quarter typically does see a seasonal dip when we look at insolvency levels. But what we saw in Q3 was that was a little bit more than expected on the consumer proposal side, which is some good news. Bankruptcies, however, we did see an increase year on year, although they still are well below the 2019 levels. It's taken a long time for those to come back up again, which is some good news. We are seeing average insolvency amounts, though, increase compared to 12 months ago. They're up almost 16%. And we did see an increase in the percentage of insolvencies coming from consumers that have a mortgage. And that's both on the proposal and on the bankruptcy side. So that likely is going to be impacting that average because typically those consumers do carry more debt on average. Surprise insolvency-wise, so this is where there isn't really a pre-warning that a consumer is in financial difficulty by looking at payment behaviour. They haven't missed any payments. That still continues to increase in terms of when we look at insolvencies. There's more insolvencies occurring where we don't have a prior warning. So if you are a lender, I highly encourage you to be looking at that population a little bit more and keeping an eye on those. So when we take a bit of a deeper look into why the consumers might be starting to struggle a little bit more, we can see that some of the increased payments that they are contending with is likely going to be one of the culprits. So on the left-hand chart, this is non-mortgage products, and we're looking at the monthly minimum payments that they have compared from this Q3 of this year to 2019. Now, the biggest movements, which are probably unsurprising, really sits for those products where there is a direct correlation with increasing interest rates. So whether that's higher balance or whether just the product itself changes with interest rates. So new installment loans, that's sitting around $140 extra per month on average. Auto loans, new auto loans around $125. And home equity lines of credit, we're seeing those minimum monthly payments are actually up on average around $330, which is quite a significant increase. And that's likely contributing to why we're seeing some of this financial stress really starting to come through. As I mentioned earlier, we are focused a little bit this quarter on Ontario and BC. And when we look at those regions, we do see they have higher than average increases in terms of financial stress. And one of the reasons is likely linked to some of the products that they hold. When we look at things like average home equity line of credit balances, they do tend to be higher compared to other regions. And therefore, those interest rate increases are really going to be having more of an impact on their monthly payments. So that's really just a summary of what's going on in the economy and high level on the consumer and high level on the product side, what's happening that we're seeing. But Kathy, maybe before we dig a bit deeper into some of the specific product movements, maybe you can give some thoughts on what this might mean for lenders and what this might lead to for consumers in 2024.
Thanks, Becky. So before I jump to answer your question, let me actually help summarize some of the key highlights that we just heard you talk about. So to start, we've seen record high immigration growth coupled with the easing of inflation because of all that lagged impact of those interest rate hikes. So when it comes to demand for credit, we've really seen this be fueled by the new to Canada population. We've also seen that outside of this segment, those that have been looking for credit, well, they've been experiencing some financial stress and they may be at risk. We also heard that the monthly payment requirements being up, and we're seeing more consumers miss payments, especially those that reside in Ontario and BC, where, again, there's financial stress and the cost of living there is much higher. So taking a pause there, and when we look outside of Canada and to our neighbors to the south, we see an emerging trend there where they've hit their pre-pandemic non-mortgage delinquency levels. Here in Canada, again, we're not quite there yet. And on the mortgage side in the US, delinquencies are still much, much lower than pre-pandemic levels. So to answer your question, Becky, what does this all mean? And as a lender, what should you be thinking about? So first off, when you're looking and analyzing your portfolio, and Becky, you alluded to that on slide 11, make sure you're carving out homogeneous segments because you may be masking risks from certain segments when you're looking at them all together. So for example, as the population starts to grow and you've got younger consumers that land in Canada, they don't have enough time to build up their credit when you compare it to somebody who has established credit. And as a result, you're going to get different behaviors that overall may look good. But then again, when you sort of double click and look at those specific segments, you start to see different behaviors pop out. Or as we saw again, the geographical differences, right? We're starting to see key differences, Ontario, BC, because again, they're impacted because of the cost of living situations being different in those environments. So again, key thing here, make sure you're leveraging segmentation techniques, to ensure that you understand where you've got those pockets of stress from consumers really coming through. Speaking of stress, again, we've seen financial stress starting to increase across the board. As always, good practice, best practice, take a look at your education and account management policies, right? You need to be reviewing them regularly. Ensure you're minimizing your risk exposure and ensure you're still meeting your financial objectives. Last thing I want to just touch on is, again, we talked about sort of more consumers are missing payments. And if they start to go down that collections path, make sure your collection teams are really equipped to handle these cases by using pertinent information on the consumer's true overall position, right? So, try to understand whether or not that consumer has a mortgage and what is that payment amount, and what's their total outstanding debt, not just what do they owe you, right? Key here is really to understand the overall picture and understand that consumer so that you can work with them to find a path for recovery that is specific to their unique case. Okay, so taking a pause there, and with the new year right around the corner, we're all probably wondering, what are we going to expect in 24? What's going to happen? So we're going to put a spotlight on consumer proposals and bankruptcies. So for both, we actually expect to see an elevation. And the reasoning behind this is as follows, right? So when we look at the chart, when we look at the proposal line, which is depicted by the orange line, the main reason why we expect more of this to increase over time is because, again, that consumer's cash flow, the impact, again, inflation, cost of living, and the economic conditions are weighing on many consumers, right? And if they are having a hard time paying down that non-mortgage debt, and they start to miss payments, or in some cases, as we heard, they may be just, making minimum payment amount. At some point, a consumer might just say, what, I can't do this anymore, right? And as a result, again, filing for proposal might be their option so that they can protect their assets if they've got any. On the flip side, right, those that have a mortgage, and especially those that have a renewal coming up, and if they have to, experience that drastic payment shock, again, the consumer might not be able to keep up, or they have no way to make their monthly payment. And again, in this case, it might result in that consumer having to file for bankruptcy and experience that foreclosure. So again, as a lender, key thing here, look out for warning signs, make sure you're monitoring your book, and again, stay close. At this point, I think before we dive into cards, I think we've got a poll question for our audience.
Yeah, I think we do. So this is your opportunity to participate, although I do really like the thumbs up, thumbs down that we're getting, particularly when it was bankruptcies are going to go up and I saw a thumbs down. So thank you for whoever did put that on. So Sandra, I don't know if you can maybe pop up the polling question. So please do take part if you can. It's great just to kind of get your thoughts on things. So the question at the moment for this stage is, which of these global economic headwinds do you think has the greatest potential to impact your business? So we have inflation, we have rising interest rates, and we have rising delinquencies. So I'll just give you a few seconds. Please take part. Choose one of those and let's kind of just see how all of you out there are feeling. Okay, Sandra, do you want to pop up the results? And that's a pretty even split on the last two. So inflation actually, I think it's down from some of the polls that we did earlier on in the year. Probably not one of the highest concerns, given that is coming down. Definitely the delinquencies and the interest rates. So the good news is we're going to be giving you more information in a second on what's happening with delinquencies and some of the impact of interest rates. So Swarnima, maybe if we can hand over to you and you can talk to us a bit more about credit cards and why we're seeing some of this huge balance movement.
Thanks, Becky. So we're definitely going to touch upon all the three polling options in the upcoming slides. As usual, we will start off with credit cards. Credit card balance debt, as we have been telling you, that this has been growing since last year. Outstanding credit card balance is now at a record high of $113 billion. And if you look at this chart, the inner circle in the chart is the balance distribution of 2022 versus the outer circle represents the card balance distribution of 2023. And now there are multiple things that are driving the credit card growth. First is definitely the new to credit and new to Canada growth. We now have, as Becky mentioned, more than 1.2 million credit active consumers than we had 12 months ago. And credit card is one of the first products that anyone new to the country gets usually within the first 6 months of opening a credit file. Now the balance in this section is now up by 26% from what we have seen from new to Canada segment from 2022. Second factor is the growing balance from missed payments. More consumers are going delinquent on their credit cards and hence contributing to the overall balance growth. But the major portion of credit card balance is divided among revolvers and transactors. And so consumers who pay less than 90% of their balance and consumers who normally pay full amount of their balance. And we are seeing a shift in consumer payment behavior. Your growth in revolving balance has outpaced the balance growth that we normally get from transactors. Almost 50% of 113 billion credit card balance comes from credit card revolvers. High cost of living, more credit card usage, and new credit growth, they're all contributing to the overall credit card balance. One of the major drivers of credit card debt is the growth in new credit cards. The chart on the left shows new card originations in gray bar and the average credit limit on new card in orange. And as you can see, close to 1.5 million new cards were issued this quarter. I mean, if you look at last 12 months, it's up to 6 million new credit cards being added to the credit card portfolio. So new to credit consumers tend to be a big part of new credit card growth. And for this quarter, 30% of new cards came from new to credit. And this portion is up from 23% that we saw in 2019. The average credit limit assigned on new cards is also at an all-time high, but it is starting to go down. And if you look at the chart on the right, it shows the change in new originations by credit scores. And we are seeing a bigger portion of new card growth being driven by high-scoring consumers. And it shows that lenders are being cautious with new originations. The second component of balance growth is credit card spend. Now, the chart on the left shows average consumer spend per credit card holder. We have shared this chart in past webinars. We have seen a huge spike in credit card spending in 2022 coming out of the pandemic. But the credit card spend levels are no longer rising in 2023. Consumers have pulled back on spending. And to measure the actual real spend behavior, we removed the impact of inflation from credit card spend and recreated this chart excluding inflation. The chart on the right now has spend levels with inflation index at 2018. And here we see the actual movement in spend. We see an increase in spend levels in 2022, right after the pandemic, but not as high as on the chart on the left. The green line here is the spend line for 2023, which is lower than 2022, which shows that consumers have really pulled back on spending. And if you take out inflation, you actually see that drop in credit card spend compared to last year. Now, retail sales have been flat compared to last year. Housing cost is high. Minimum payments, as Becky mentioned, for credit products are up. So consumers are prioritizing payments over spending. So spending has slowed down, but balances are still rising. That that means consumers are paying less and less of their outstanding balance. We are seeing a shift in payment behavior. So there's an increase in minimum payer for credit cards. It's up from 2022. The percentage of consumers revolving 75% of their balance is also up. So more and more consumers are paying less percentage of the balance. And we are also seeing a turn from consumers who were frequent transactors are now becoming frequent revolvers. So because the transactor percentage is also down from what we saw last year. And consumers are paying 97 cents for every dollar that they're spending. So spend to payment ratio gap is widening, especially for younger consumers. Low pay rates are obviously translating to higher delinquencies, and stress levels are very much visible for certain consumer groups. So let's start with the vintage chart on the left-hand side. You can see that there are newly opened trades that have missed payments after 6 months of opening and have a much higher delinquency rates than accounts that were opened in 2019. So all the newer accounts that got opened in 2022 and early 2023 have already started missing payments on card at a much higher rate than we would have seen the credit cards that were opened in 2019. And major increase in delinquency is coming from consumers where credit score at the origin, when they've got the credit card, was under 660. But we're also seeing that trickle down into higher scoring consumer groups as well. And the chart on the right shows the 90 plus delinquency levels for credit cards. What we did was we split this chart into two portions. So consumers who have a mortgage versus consumers who do not have a mortgage. And we see that for mortgage holders, the delinquency dropped at an all-time low during the pandemic. But since 2023, card delinquencies on mortgage holders is increasing at a faster rate than non-mortgage consumers. Initially, the stress levels were more visible for non-mortgage consumers, but now after the interest rate increases in 2020 from 2022, we are now seeing that impact in 2023. And especially when you look at the dotted lines, Ontario and British Columbia, two provinces that have seen a significant growth in housing market, are now seeing a very higher rise in credit card delinquency at a much faster pace, and they're almost reaching 2019 levels. And so the impact, like we've seen the impact of interest rates, how it is indirectly impacting credit card payment behavior, but it is also impacting unsecured and secured line of credit, so both variable rate products. For unsecured line of credit, the balance delinquencies are now above 2019 level. Now, this has impacted consumers under the age of 35 years because ULOC, unsecured lending, line of credit is usually a more popular product among younger consumers, and it's driving the rise in delinquency. Average balance per line holder is also increasing after remaining low for the last 2 years. And more consumers are drawing from their lines to meet expenses. And as we discussed in the past webinar, and a lot of consumers are using their lines to pay off their auto loans. So a lot of those things are contributing to the rise in the unsecured line of credit delinquencies. Yeah, sorry. The next impact is definitely visible on home equity line of credit, which is the secure line of credit. And this is a product that is more popular among older consumers, consumers who already have a mortgage and also have a HELOC. We are seeing that the delinquency levels are fast approaching pre-pandemic levels. They're still not over 2019 levels, but they're nearing it. But for seniors who are 65 plus, the delinquency levels are actually higher than 2019. And this is another segment that we saw struggle even during 2018 rate hikes, where this was the portion of consumers who had higher HELOC balances. And regionally, again, it's Ontario and British Columbia with higher average HELOC balances that are showing an increase in missed payments. So consumers with high HELOC balance, over 50,000 balance, are paying less percentage of their credit card balance as well. So the drop in transactors is much higher in this consumer segment who have a HELOC and have a large HELOC balance. Now I'll hand it over to Kathy to explain what this means for the lenders.
All right, thanks, Swarnima. So as always, lots of new insights. So what I like to do is quickly just highlight some of what we just heard to put it into context. So first off, we've got record high for credit card balances, right? So the demand for new credit is still high, and we're seeing a big decline when it comes to those payment rates. So consumers are clearly using their cards less, given that pressure from the higher cost of living. But also because they're not able to pay off that credit card, this is what's leading us to really see more transactors convert to revolvers, and we're seeing more minimum payers, right? So just to make sure we're all on the same page, and a quick reminder to everybody, a transactor is somebody who's paying off their balance in full each cycle versus a revolver who isn't, and now has a balance that has interest charged on top, okay? So taking a quick little trip around the world, and we look elsewhere, in the US, we see that the card delinquency levels there are now higher than the pre-pandemic levels. And across the pond and down under, so short for the UK and Australia, they're starting to see that many more missed payments, again, signaling that they're also seeing financial stress there as well. And also, the key thing here is, why are these insights important? These cards markets are really similar to Canada. So keeping abreast of what's happening in terms of emerging trends elsewhere is important to Canada because usually, we're a fast follow here. So coming back home to Canada, again, question out there is, what should lenders be thinking about when it comes to credit cards? So let's start with touching on growth, right? So there's clearly a demand in the market for new credit, but as we saw, there's recent vintages really showing missed payments within the first 6 months of opening, even for high scoring consumers. So as a lender, it's going to be very important, again, sound segmentation strategies and segmenting those consumers once they're on your books. Second thing I want to call out, monitor. Okay, so really stay close to those consumers, ensure they're not headed towards financial stress. We're showing, again, any early signs of missed payments on any of their other payment obligations, right? And again, the other key thing to look out for is that cash flow capacity. Has it been reducing, right? That's a main sort of early warning sign. Again, if they're headed down that slippery slope, you need to take the necessary mitigation steps to make sure that you don't have a downstream issue for your collections department. Okay, just taking a pause there on what's actually been happening. Let's look ahead, right? Let's see, what do we expect to happen in 24? So to help sort of set up the outlook, let's talk a little bit about roll rates. So left-hand chart is showing us a time series of credit card roll rates, which simply is the percentage of how much of last month's balance is now 30 days plus days delinquent, okay? So what you see here is that over the past year, we've been seeing it trending upwards, showcasing that the balances each month are becoming delinquent. Now, if we also factor in the fact that we've been getting growth from that NTC new to Canada population, we're going to expect that the overall card balances are going to keep increasing. So the net result, when we look at the delinquency rate outlook, which is the chart to your right, delinquency rates are going to be obviously on the rise. But again, they're also being masked because of that growth in that denominator from the calculation. And so in terms of hitting that pre-pandemic level, we're expecting that's going to happen probably around Q3. And by the end of 24, we're going to expect that we're going to be 20% higher in terms of delinquency rates compared to 23. So on that note, I think time to take cards off the table and shift some gears a little bit and talk about what's been happening in the auto industry. So Swarnima, back over to you.
So Kathy, actually, maybe if we just take a brief pause. I know there's quite a few questions, credit card specific, that have just come through. So maybe we could just quick fire a few of those. So I think we had a question, are the increase in delinquencies in new credit cards driven by new to credit or existing credit consumers? Swarnima, do you know the quick answer to that?
Yes, sure. I think a lot of the credit card delinquency is now coming through existing consumers. So consumers who already have a wide product coverage, consumers who already have a mortgage, who already have a HELOC, who already have auto loans. So consumers with extremely high monthly payments are now going delinquent at a faster rate. The delinquencies from new to credit, we can assess that only after a certain point in time, once they have all the products like credit cards and auto, and once they have built their credit, and then I think we can assess their delinquencies better. But for now, a lot of especially credit card delinquencies are originating from Ontario and BC, consumers who are already heavily leveraged and who mostly have a variable rate mortgage.
Okay, great. So there's a question, is the percentage of utilization of credit limit increasing? So I can answer that very quickly. Yes, it is. It's up around 4% compared to 12 months ago. Do bear in mind, though, we have a lot of growth in the credit card space. So again, you are bringing in some of those new cards with no utilization, and yet it's still increasing. Average balance overall, when we look at credit card holders, is up around $400 compared to 12 months ago. Do we know what percentage of consumers are paying the minimum or less? Purely just the minimum, it tends to be around 4 or 5%. If you include revolvers, kind of less than 25%, that gets closer to around 24%. And there was a question somewhere, I can't quite find it, linked to what does that look like for Ontario? So if we look at the shift in terms of those consumers paying 25% each or less each month, on average, it's up around 5% compared to 12 months ago. For Ontario, that's up 7%. So that's kind of seeing some of that additional stress coming through for Ontario, and similar for BC, I think. So maybe I'm conscious of time. Do you want to carry on with auto loans, Monica?
Yeah, sure. Thanks. So auto new originations are improving, but we are also seeing financial stress coming through for auto, especially from subprime consumers. Let's start with new auto originations for non-bank and captive auto lenders. And newer volumes have been down during the pandemic with supply chain issues, vehicle availability issues. But now, like if you look at compared to last year, we are seeing auto market rebound. We are seeing year-over-year growth in new auto originations. But the levels are still much lower than what we normally see in the third quarter of the year. Normally, third quarter of the year is where we see peak auto loan originations, but we are not seeing that anymore. And and we are also seeing an increase in auto leases, which has been going down over a year now. And we are finally seeing some increase in new auto lease originations. And it's the older consumers that are driving these leasing demand up. Overall, the average loan amount for auto leasing has also gone down from the last quarter and is now at $31,000. So that is also an incentive for people to start taking up auto leasing again. And just like credit card, we are also seeing higher new originations from prime and super prime consumers for autos. So yes, more consumers with a higher credit score are applying more for auto loans. And highest growth in new auto loans was seen in Quebec, followed by Ontario and British Columbia, where we have seen higher immigration and higher credit demand as well. And while new auto originations are improving, auto delinquencies are on the rise. It's one of the credit products where we have seen higher than pre-pandemic levels in auto delinquencies. And in some region, it is nearing 2019. And again, as we have seen, as we have discussed it, that it's BC and Ontario where a lot of the credit product delinquencies are coming through. And even for auto, the highest increase so far has been in BC. Like it's much higher than what we had seen in 2019. And even considering the peak auto delinquencies that happened in 2020. And a lot of these delinquencies are being driven by newer auto loans. So most new auto loans opened in 2022 and in 2023 have high loan amounts with high interest rates, with average payment up by over $100 when compared to what consumers used to pay back in 2019. And many auto loans originated in 2022 have already started missing payments on their auto loans. And a lot of these delinquencies are coming through from consumers in the age range 25 to 45. They have higher auto loans and they have higher monthly payments as well. And we are seeing a big rise in severe delinquencies from this group. Now, if we move on to bank auto loans, the new car segment is where we have seen some growth from last year. Again, it is lower than the past peaks, but the originations are still improving. But there has not been much relief in new car prices. Average loan amount on new car continues to rise. We have seen year-over-year growth. We have seen quarter-over-quarter growth. It has not gone down from increasing since the pandemic. And high loan amounts, again, in addition with current interest rate, is constraining new car demand. The chart in the slide shows the distribution of new car loans across interest rate bands. And as you can see, the distribution is getting skewed towards higher rate loans. A lot of those zero interest loan offers that we used to see pre-pandemic no longer exists. Monthly payments on new cars are up over $190, and in some, when compared to new cars that people bought in 2019. And average interest rates on new cars has seen a major shift in the last 2 years, and it is making affordability challenging for many consumers. Now, looking at the used car market, again, another segment which has seen massive change in auto. Like used car demand has slowed down this quarter when compared to highs of the last year, but it's still pretty high compared to what we have seen pre-pandemic. And used car prices have started to go down after a huge spike that we saw back from 2019. Now, average loan amount on used cars saw an exponential rise during the pandemic. We have not seen used car prices go that high ever. And with supply chain issues easing now, vehicle availability improving, used cars are seeing a quarter-over-quarter drop in average prices and average loan amounts, but it is nowhere close to 2019. As you can see on the slide, the average loan amount on used car went from $25,000 to $35,000 from 2019 to 2023, a very significant rise for used cars. And higher loan amounts have now led to extension of amortization terms on used cars. 70% of used car originations now have a term longer than 6 years. An average loan amount on used cars is now over $600. So the slowdown in used car prices will definitely help normalize the used car market. But now looking at delinquencies, overall bank delinquencies are below pre-pandemic levels. But again, if we split it by new and used car market, it's the used car that we're seeing the highest increase in payment arrears, and it's increasing faster, and for some regions it has crossed 2019 levels. The solid line in the chart shows the 90-plus days balance level delinquencies, and the dotted line shows the account level delinquencies. And why we're looking at both is to make sure that the rise in the overall balance amounts are not masking some of the balance level delinquency rates. So used car delinquency rates, as you can see, is being driven by loans where the average interest rate on used cars was higher than the average rates. So high interest rate loans on used cars are seeing bigger increases in their delinquencies. And a lot of these loans are originating from subprime segments. And they're, again, looking at the vintage level views, they are going delinquent as early as 6 months from opening. So the shift in the used car market over the last few years has really started to impact consumers and could lead to further rise in delinquencies. I'll let Kathy expand more on that. Over to you, Kathy.
Thanks, Swarnima. So again, a quick little recap in terms of what we heard. We heard some great news. Auto originations are back up for both the auto loans, and now we've got auto leases in the mix too. So good news. On the auto loan side, we see that the used car market is doing a lot better because there's more vehicles that are available, which means, as supply increases, prices are normalizing, coming down, and that used cars are, a viable option for consumers. On the leasing side, we saw that, that's also been increasing, and it's mainly being driven by that 55 plus consumer cohort. We also heard some bad news. Okay, so missed payments continue to rise, and the delinquency rates for auto loans are back up to pre-pandemic levels. So root cause, again, appears to be coming from the captive subprime market, which is mainly driven by that younger age cohort, 26 to 45, that have those average higher monthly payments. So quick little spin around the world, similar trends happening elsewhere. In the UK, they're seeing arrears grow there for their subprime market. And same thing in the US, subprime loans there are starting to stand out as missed payments start to sort of increase. So coming back to Canada, key question again, what should auto lenders be thinking about? So as we continue to see that auto demand rebound. Again, as always, best practice, take a look at your origination strategies, make sure that they're optimized. Are you using predictive credit attributes to make those sound decisions? Second thing, for new loans that are booked, again, monitor closely. Ensure that, again, if there is any missed payment trends happening on those new vintages, again, it's not going to impact your portfolio because, again, you're monitoring. Make sure you've got some great account management programs to monitor your portfolio. Again, staying up to date on the overall financial position of your customer, not just what they're doing with you, but overall, again, looking for any early warning signs of stress that pop up. Last thing, again, we've talked about this before. Swarnima mentioned it briefly. There's those pocket of consumers that bought some really overinflated sort of used cars during the pandemic, where they paid quite a bit for them. So they've got some higher LTVs, right? Which means they're probably higher than what the asset is worth. So that's a risk. If those consumers do experience any type of financial stress, paying that loan might not be at the top of their payment hierarchy. So keep an eye out on that specific pocket. Switching gears now and just taking a glimpse ahead into 24. Again, leveraging roll rates. I'm not going to go through what they are again because I've mentioned it already, but what we see over time this past year is that it's been trending upwards, right? So as a result, it's going to be correlated to the fact that next year we expect the 90-day plus delinquency rates to climb in 24. Key drivers, again, have to do with delinquencies really coming from that captive and subprime market. So we continue to think that that's going to be a reoccurring trend. And here, even though we've got population growth happening in the background, vehicles are still costing quite a bit of money and we've got high interest rates. So growth in terms of, new to Canada, new to credit, it's going to be muted here in terms of, them looking for new vehicles and new auto loans. So here is where we think the delinquency rate calculation, that denominator, it's not going to be impacted. And so we see that incline in terms of delinquency rate will be a little faster. So by the end of 24, we expect to see delinquency rates about 23% higher than what they were this year. So I know I just raced through that and I apologize. We're going to park this auto talk for now, and I think we're going to jump into what's been happening with the housing market. Oh, Swarnima, we can't hear you.
Sorry. It's no surprise that this was another slow quarter for mortgage. Overall mortgage balance went up by 3.5% from last year, which is one of the slowest increase we have seen for mortgage in the past 2 years. And the chart below shows year-over-year growth in mortgage balance. And it is important to know how huge was the mortgage growth during the low interest rate periods to understand how it has impacted the current mortgage market. Let's start with new originations. New mortgage originations reached its peak in 2021, but it has been continuously dropping year over year since the interest rates started to rise. And this quarter, it went down by 9.5% when compared to last year, and despite a seasonal increase from last year. And the slowdown in mortgage market started to stabilize house prices. As you can see in this chart, the orange line depicts the average loan amount on new originations. And you see a small dip in 2022, but it has started to go back up again this year. While the loan amounts are still high for Ontario and British Columbia, the biggest increases in loan amount is now coming from other provinces like Atlantic provinces, followed by Manitoba, which didn't see the same increase in home prices as these two provinces during the pandemic. But the overall slowdown in the mortgage market had a huge impact on house prices, has not had a huge impact on house prices as people were expecting. And affordability still remains low for many first-time home buyers. Okay, so now we get back to the overall mortgage balance growth and how it has impacted, how it got impacted by the mortgage frenzy that we saw in 2021. The share of variable rate mortgages has definitely increased from what we had pre-pandemic. And we estimated close to 63% of outstanding mortgage balance as fixed, which is 2% lower than 2022. And even among the variable rate mortgages, the fixed payment variable rate mortgages, many have hit their trigger rate, which means they are now making only interest payments. The amortization term on those mortgages have extended. And in case when a mortgage hits a trigger rate, consumers have an option to pay a lump sum amount or increase the monthly payment or switch to a fixed rate mortgage to make sure the payment covers more than just the interest and mortgage does not go into negative amortization. So where balance start to increase instead of actually going down. And we also estimate close to 10% of mortgage balances have hit their trigger rate already, and around 4% could potentially be hitting trigger rate if rates keep going up. And the chart on the right side explains it much better. You can see it's a chart for variable rate mortgages open from 2019 to 2022, and their estimated amortization term at inception versus their current amortization term. And we see a big gap in amortization terms for mortgages open in 2021. And some of the mortgages have ended up extending the term by 5 years in many cases, which will put more financial pressure on mortgage holders. To assess financial pressure originating from mortgages, it is important to get a regional view. As we have seen throughout this deck, a lot of delinquencies are originating from Ontario and British Columbia, especially for consumers with a mortgage. And both of these provinces were the hottest mortgage market during the pandemic with high loan amounts. And while mortgage payment requirement is up in all regions, average mortgage holder in these provinces is now paying more than $200 to $2,500 and in monthly payments, which is up by over 30% when you compare to 2019. And as mentioned previously, the consumers with a mortgage have started to miss payments on mortgage products, but many have now started to miss payments on their mortgages as well. And if you look at the chart on the right side, which is the balance level delinquencies for mortgages, Ontario delinquencies are now above 2019 levels. It's not by a lot, but yes, it is above 2019 levels, with British Columbia almost nearing 2019. The good news is for the other provinces, the delinquencies is much lower than pre-pandemic. Now, we have talked about the financial strain originating from consumers with a variable rate mortgage, but there is another segment that we have been monitoring closely to assess the impact of payment shock. And these are consumers who have renewed their mortgages in 2022 versus 2023. And the chart on the left shows consumers who have missed at least one payment on a non-mortgage product. And we are seeing that the recent renewals where there has been a payment increase are already struggling to make payments for other products. And while this volume is very small right now, it is an early indication of upcoming financial stress from mortgage payments for those who will be renewing their mortgage in peak interest rate periods. And when we track mortgage delinquency using a vintage view, again, many mortgages that opened in 2022, 2023 have started to miss payments as early as 6 months from opening. And while 25% of these mortgages are from first-time home buyers, a major chunk of new mortgages remains renewals and are at potential risk, with monthly payments having increased considerably after renewal. I'll hand it over to Kathy to provide a deeper insight into what this means.
Thanks, Ranima. So clearly we're still dealing with a cooled off housing market because of the impact of the higher interest rates. Overall, we've got less people selling, less people buying. So when we talk about growth, it's really being driven from the renewals that are coming from the consumers that are clearly shopping around for a better deal. We also heard that the 90-day plus mortgage delinquency rates are really standing out for Ontario and BC residents. And we're starting to see missed payments increase, especially, again, from the consumers that are renewing and experiencing those payment shocks. Elsewhere in the world, again, our friends down under Australia, they're seeing a big impact there as well. For first-time home buyers there, they're clearly at risk and they are going delinquent and they are missing payments within the first year of their mortgage. So not a good story, but again, as a mortgage lender, what should you be thinking about? So first off, consumers that are in a vulnerable state, there's a mortgage charter with guidelines that are meant to be exercised by the banks to help really consumers that are experiencing this financial strain, right? So there's 6 guidelines, measures like extending amortization period, allowing consumers to make those lump sum payments so that they don't have that negative amortization, waiving fees and costs associated with mortgage relief. Those are just a couple of examples. And again, leverage those guidelines to help the vulnerable. We heard yesterday Bank of Canada held interest rates, but there is an expectation that in 24 at some point they're going to start to come down, which is why we believe that consumers are also probably deferring buying a home until next year. So as a lender, do expect that growth will start to rebound next year. And again, make sure your policies are tweaked to make sure that you understand the consumer's overall risk and cash flow capacity. Last thing, again, there's an expectation that there's going to be a lot of renewals in 24 and a lot of renewals in 25. So again, payment shocks, we talked about them. Consumers experiencing this year are at risk of going delinquent. So again, make sure you're as a lender, you're looking for early warning signs to make sure that, again, if anybody is vulnerable, you're exercising some of those guidelines that I just mentioned. Again, quickly looking ahead into the future, what do we expect? Here we go again, roll rates. When we look at those roll rates, again, when we look at the trend, it's been a little bit sort of flatter. And again, that's correlated to the fact that we've got a softer market. If you look to the right, this is where we've got the projection. Again, next year, we're going to expect more renewals coming, but there's also going to be those payment shocks coupled with a little bit of more growth. This is why we're expecting sort of the delinquency rate will be slowly trending upwards. So by the end of the year, we expect about 17% higher compared to this year. So sorry that I raced through that, but we're running out of time. So Becky, I'm going to hand it back to you.
Thank you so much, Kathy. And thank you so much for all the questions that we've had. I think we've had 40 questions. So I've been trying my best to answer them along the way. If we haven't answered them, we will get to them. Just before we finish off, a couple of kind of updates in terms of our next sessions. On January 11th, we have Sinead and Pierre who will be doing our business credit trends. So if you are interested in the commercial side, please attend that. You should have in your console a way in which you can register. But if you don't, if you can't find it, please let us know and we will make sure we send you the link. And then we also have on January 18th a live webinar and demo of our Equifax Credit Health product. This is really about trying to talk to you about how we can help deliver credit scores in our digital world. Apart from that, just a huge thank you. I know many of you join us every quarter and we've a lot to talk about in this session, so thank you for staying with us and we will be with you again in the new year. Thank you so much.